In this video, I will be giving you an introduction to accounting and also introduction to elements in the accounting equation. First, we'll learn what is accounting. So when it comes to accounting, it is a language used by the business organizations, and it is a system of recording, summarizing and analyzing an economic entity's financial transactions. And also, effective communication of this information is a key to have a success in the organizations. So this financial information are required for internal users as well as to the external users, and the accounting information is used by the internal users such as owners, managers, employees, and when it comes to the external users, these are used by the government, other financial investors, banks, etc. So here I have give you an introduction to the accounting, and it is a definition which is given by the American Institute of Certified Public Accountants. The art of recording, classifying and summarizing in a significant manner in terms of money, transactions and events which part at least of a financial character and interpreting the result thereof. So as I explained earlier, accounting is a language that we use to record the transactions which has taken place and to classify it like income, expenses, cost of sales. So likewise we are classifying, and then summarizing in the sense we take all the relevant related information, the similar information into one place, and then we use that information to take decisions in the business organizations. So moving to the next one, when it comes to accounting, we have two branches of accounting. We have the financial accounting and also the management accounting. So there are differences between these two. Financial accounting is more into the external parties, and management accounting is more into the internal parties. In the financial accounting, we try to give information, the accounting information, to the people who are located outside of the business organization. And management accounting is more beneficial and aiming to help the managers to take their decisions regarding the business activities. For an example, we are understanding the cost per unit and also the absorptions, overheads when it comes to particular departments, how we are going to add it for the product. So likewise, we are taking some idea from the management accounting. So moving to the next topic, we have functions of accounting. So when it comes to the functions of accounting, we have 6 main functions as I have given here: collection of information, classification, recording, summarizing, analysis and interpretation, and then finally communication. So here collection of information means we are collecting the receipts and the vouchers and also other source documents that we can use for our accounting purpose. And then we classify them. We classify them as income, expenses and other cost of sales, and then we are taking them as assets, liabilities. So we classify them under different terms. And then we record all the transactions. If it is a cash related transaction, we are recording it in our cash book, and if it is anything related to sales, so we are taking to the sales account, and so we record all these transactions in the books of accounting. And then we summarize all these transactions, and then we prepare the trial balance to check the arithmetical accuracy, whether we have recorded the debit and the credit entries. And also we are preparing the income statement or the profit or loss statement, and also the statement of financial position. So by preparing these two statements, we are trying to identify the net profit and also the position in the organization. And then when it comes to the assets, liabilities, equity, whether the company is a good state or a position, whether they are in a good position to pay their liabilities with the available assets. So likewise, we are taking some idea by preparing these financial statements. And then in the fifth function, we are analyzing and interpreting. So this interpretation can be done by using the financial ratios, where we check the liquidity ratios, profitability ratios. Okay, so by looking at the profit and the cost we are incurring to earn that profit, whether the company is in a good position or not, whether the company have the sufficient assets to pay off its liabilities. So we are taking all these decisions by looking at the statements that we have prepared. And then finally we are communicating this information. So we are sending off the financial statements to the people who really require this information for their decision making purpose. So the next thing, financial accounting. So as we have spoke, financial accounting is again, it's recording, processing and presenting the economic information for the people who are in the outside of the organization. And then the next one is management accounting. So management accounting is more focusing on the managers and guiding and assisting them to take decisions, to plan, control. So now let's look at the accounting terms. First we have the assets. So when we call the term assets, assets are the resources which is in the business organization, and these resources are today with the organization because of a transaction which had taken place in the past. And these assets are helping the organization to gain economic profit, and also these resources are managed by the business. Now let's say for an example, if the business is executing its activities on a rented place, someone else's property, so in that case, even though they are in a building, they cannot list it as their own assets because it is not managed by them. It is not with the ownership of them. And so when it comes to the assets, the inflow of the future economic benefits. So there should be a future economic benefits inflow from this particular asset. For an example, we can take the resources such as buildings, motor vehicles, and then the inventories, and then the cash. So these are few examples which is coming under assets. So now when we look at the assets, based on the time frame that they are in the business and they are used by the business, we can categorize the assets into two types. So we have current assets and then we have non-current assets. So current assets are the assets which are expected to be used, sold or converted into cash within a very short time period like 12 months. That means we will be completely finishing, used, sold or convert them into cash by within the 12 months time period. For an example, inventory. So are we going to keep inventory for a very longer time? No. We are trying to sell it as much as possible, okay, within the very short time period. And also let's say we have a debtor. So debtor means whom? He is a person who having a debt for us. He needs to pay us. So in that case, are we going to keep that debtor for a very longer time, more than 1 year? No. We are trying to collect that money as much as convenient and quickly. So then here the examples like inventory and debtors, cash in hand, cash at bank, so all these will be coming under current assets. That means these resources will be in the business organization for a shorter time period. That means within 12 months they will go away. So the next thing is non-current assets. So when you have the non-current assets, that means these are the resources which is not categorizing as the current resources, current assets. They will be in the organization more than 1 year time period. Mainly land and building, machinery, furniture, equipment, motor vehicles which are used by the organization for its activities will be coming under non-current assets. So next one, we are moving to the liabilities. So here when it comes to a liability means it's a payable. You are having a debt for someone. So this payable have aroused because of a transaction which has done in the past. So it is obviously an obligation. You need to pay them. For an example, we can take a bank loan. So now this liability also can be divided into two types as current liabilities and non-current liabilities. This is also categorizing based on the time period you are taking to pay it back. So when you look at the current liabilities here, the debts that you will be settling off within 12 months time period are what we known as the current liabilities. For an example, let's say you have purchased some items on credit basis for resale. So in that case, your trade creditor will be your current liability. And also let's say you have missed to pay the electricity expenses last month. So then there is a accrued electricity expense for you. So in that case, this accrued expense will be a current liability. Why? Because you will be settling these payments within 12 months time period. You are not taking more than 1 year time period to settle them. And non-current liabilities are the liabilities that we will be settling after 1 year time period. For an example, let's say you have a bank loan. Now, after 1 year, the portion that you have to pay for that particular bank loan will be coming under non-current liability here. And then we are moving to the equity section. So what is equity here? It is the assets given by the owner to the business. When it comes to the income is a earning that you gain from your operational activities. And in other terms, we can define income as the increase in equity other than the capital introduction given by the owner. When it comes to the examples of income, we have sales, interest received, rent received, commission received. So these are examples for income that we are gaining in the business organization. So now we have the fifth element, that is expense. So expense means the resources that we contribute to earn an income in the operational activities of the business. So regardless of the drawings, if there is any reduction in the equity, we define it as an expense here. Expenses examples are salaries, wages, insurance expenses, cost of goods sold, and then interest expenses. So these are examples that we can have for our expenses. So I hope with this explanation you got any idea regarding the 5 main elements in the accounting equation. Now let's look at what is this accounting equation. Okay, so here accounting equation is assets equal equity plus liability. This accounting equation is showing the relationship existing between the assets, liabilities, and also the equity. So the total of liability and equity is equal to the total of assets which is having in the business organization. So this accounting equation is the basis for us when it comes to the double entry accounting system. With that, we are coming to an end in our video. So let's try to quickly recap what we have learned so far. So we have understood what is meant by accounting. So it is the language which is used by the business organization when it comes to recording the transactions which has taken place with related to monetary terms. And then we have learned what are the definitions for accounting and also the functions of accounting. And then we have learned the two branches of the accounting, financial and management. And then we have learned the elements in the accounting equation: assets, liabilities, equity, income and expenses. So we have learned how we can categorize them depending on the time period and what are the examples. And then finally we have had a look on the accounting equation: assets equal equity plus liability, which is providing the basis when it comes to recording the transactions under the double entry system. I hope this video was helpful for you to get familiar with the accounting definitions and the terms. In the coming week, I am planning to add more videos in accounting. If you want me to cover any specific topic, you can comment them in the comment section below. If you enjoy this video, put a thumbs up, and if you consider upgrading your skills in accounting, so you can subscribe my channel. Thank you for watching and see you in the next video.